Welcome back to the Deep Dive, the place where we take the contracts and dense research that govern your life and turn them into highly valuable, immediately understandable knowledge. Today, we are cracking open one of the most critical yet least understood financial contracts most of us hold: homeowners insurance, or HOI.
It really is. It's the single biggest protection for your largest asset. And for so many people, the policy documents just feel impenetrable. Like they're almost intentionally designed to be confusing until the moment you actually need to file a claim.
That's the fear, isn't it?
It is. So our mission today is to, cut through all that complexity. We're drilling down into the source material research, legal definitions, industry reports, all focused on property insurance to really understand the foundational structure.
And to expose the common financial traps, I'm thinking of things like co-insurance.
Exactly, co-insurance, and to analyze the massive external pressures, specifically climate change and financial strain, that are reshaping the entire industry right now.
That sounds like a necessary shortcut to being well-informed. So let's start with the basics, but with a bit more precision. The source material defines homeowners insurance not as a single thing, but as a multiple-line insurance policy. Why is that dual nature so important?
That technical term is, well, it's crucial because it immediately clarifies what you are actually paying for. A multiple line policy just means it combines two major, very distinct types of protection under one roof. Think of it as two separate contracts stapled together.
The two core components being property and liability.
Exactly. First, you have the property insurance components. This is what most people think of. It's covering damage to the physical structure, the dwelling, coverage for detached structures like a garage or a shed, and then compensation for your personal contents. It also includes a safety net for additional living expenses if you're displaced during a repair.
Okay, that's part one.
Part two is the liability coverage. This is your personal financial protection. It shields you from lawsuits and financial exposure for accidents that happen at your home, or even accidents caused by you, members of your family, or your pets, as long as the incident occurs within the policy territory.
And the cost of covering all of those separate risks, the house, the contents, the personal liability, it's all just wrapped up in one annual payment.
Yes, and that leads to the second key term from the sources. It utilizes an indivisible premium. You don't pay one price for the property side and a separate price for the liability side. A single, all-encompassing premium covers all those different risks combined.
I want to circle back to something that underpins this entire industry. The sources put a huge emphasis on the principle of indemnity. Why is this one foundational concept so important for a homeowner to grasp before they even look at their policy limits?
Because it defines the expectation you should have during a claim, and frankly, it prevents a lot of serious consumer disappointment. The policy is legally defined as a contract of indemnity. Its design is not to allow you to upgrade your home or, profit from a loss. It is explicitly designed to put the insured person back to the financial state they were in immediately before the loss occurred.
So if I have a 20-year-old roof and a hurricane just rips it off, I shouldn't expect the insurance company to pay for, the newest, most expensive roofing material on the market.
That's the core tension right there. If your policy is replacement cost, they will pay to replace the old roof with a new, functionally equivalent one. But the principle remains. Restoration, not profit. If you manage to make a profit from an insurance claim, you violated the principle of indemnity and, well, you've possibly committed fraud.
Got it. And speaking of structure, our sources confirm that the U.S. system relies really heavily on standardized forms. This makes it a little easier to compare policies, but how are the limits structured within these forms?
It's highly structured, and it's all built around one central figure, coverage A, which is the limit for the main dwelling itself.
Okay, so everything flows from that one number.
Everything. All other coverage limits are typically set as a percentage of that coverage A. For example, coverage for your garage, that's coverage B, might be 10% of coverage A. Coverage for your personal contents, coverage C, might be 50% of coverage A. The whole policy budget is interconnected and flows directly from that one number, the estimated replacement cost of the main house.
Okay, now for the cold, hard reality check. The thing that often surprises new homeowners. Standard policies offer a lot of protection, but they always have standard exclusions. What are the two massive, non-negotiable risks that are always excluded that you have to buy separate coverage for?
The two major ones almost universally excluded are floods and war. You just cannot buy standard homeowners insurance that covers either of those perils. If you live in a flood-prone area, you need separate flood insurance, which is often facilitated through the National Flood Insurance Program, the NFIP.
And the sources gave a fascinating insight into how war is defined. It's not just, conventional warfare.
That's right. The exclusion for war, and this is surprising to a lot of people, it typically includes a nuclear explosion, regardless of the source. So whether it's a government action or, say, a domestic accident at a power plant, it's out. The risk is just too catastrophic for private insurers to manage within a standard premium pool.
And just for a final reminder, what's another smaller but incredibly common exclusion people often forget about until they find some serious damage?
Termites, pests, general wear and tear, gradual deterioration, that's all generally considered maintenance. It's your responsibility as a homeowner, not a sudden catastrophic covered peril. And it's a standard exclusion that costs millions of homeowners money every single year.
Okay, that sets the stage perfectly. Let's move past the philosophical core and get into the actual paperwork. How do insurers decide what they will actually pay for? This entire decision process is defined by two major coverage philosophies, named perils versus open perils.
This is perhaps the single most important distinction for you, the listener, to understand when you read your policy documents. It fundamentally dictates who bears the burden of proof if a claim comes up, and it determines the entire comprehensiveness of your protection.
Let's start with the narrower one, named perils. What does that term mean in, practical terms for a homeowner who's just had a loss?
A named perils policy is the least comprehensive. It puts the burden of proof squarely on you, the insured. The rule is simple and honestly unforgiving. If the loss or the specific cause of the damage is not explicitly listed or named on the policy document, then it is not covered, period. You have to be able to point to the exact peril on your list to get coverage. If you lose your home due to some mysterious unlisted event, the insurer has no obligation to pay.
So with a named perils policy, I need to read that list of included items very, very carefully. Okay, so now flip that over. What about the much broader option? Open perils, which is often called a special form policy.
Open perils coverage is the industry standard for most owner-occupied homes because it is the most inclusive. It operates on the complete opposite principle. It shifts the burden of proof to the insurer. It covers all losses, no matter how unusual or unpredictable they might be, unless that specific cause or type of loss is specifically listed as an exclusion.
So with an open perils policy, it's the list of exclusions that I need to be reading carefully, not the list of covered events.
That's the vital distinction. Named perils means if it's not listed, it's out. Open perils means if it's not excluded, it's in. That makes a huge, huge difference in the complexity of filing some kind of unusual claim.
It seems like it.
Absolutely. And the source material actually breaks this down into a kind of ladder of protection, illustrating how insurers structure these named peril policies to incrementally increase the coverage.
Okay, let's climb that ladder. Let's start with the base rung, the basic named perils form. What's covered there, and where would you typically see this kind of policy used?
This is the foundation. It's the minimum coverage necessary to protect the lender's interest in the property. It's designed to protect against perils most likely to result in a total loss. The list is pretty short, and it's focused on major sudden events: fire, lightning, windstorm or hail, explosion, smoke, vandalism, aircraft or vehicle collision, and riot or civil commotion.
That does sound pretty limited.
It is, and since the coverage is so limited, our sources note that this form is most often used for vacant or unoccupied buildings, which, represent a much higher risk for certain kinds of losses, like vandalism or fire.
Makes sense. Okay, step 2 up the ladder is the broad named perils form. This expands the basic list, so it's far more practical for someone actually living in the house. What 6 common types of damage does it add?
The broad form builds on that basic list by adding common risks that affect occupied dwellings, but aren't necessarily catastrophic enough to cause a total loss. These include burglary or break-in damage, falling objects, which means things like tree limbs, not necessarily something you dropped, the weight of ice and snow, freezing of plumbing, accidental water damage, say from an appliance failure, and damage from artificially generated electricity, like a sudden power surge.
That fills in a lot of the common gaps for home issues. Now, moving to the top rung, the special all-risk or open form policies. We mentioned the focus shifts entirely to that exclusion list. So what are the mandatory exclusions that homeowners must watch out for, besides the obvious ones like flood and war?
The list of excluded perils for the special form is the ultimate limitation on your coverage, and there are a lot of nuanced points here.
Give us the list. What are the critical ones?
Okay, first, ordinance or law. This means the costs associated with upgrading your home to current building codes during a rebuild are often excluded. If you rebuild, you have to comply with modern codes, and those costs are on you unless you buy a specific endorsement.
It's a big one.
It's huge. Second, earthquake. That always requires a separate policy. Third, power failure. If a utility failure outside your property causes a loss, that's often excluded. Fourth, neglect. If you fail to maintain your home and that neglect leads to a loss, coverage is denied. Fifth, nuclear hazard. And sixth, intentional acts. You can't intentionally damage your own property and then file a claim.
That ordinance of law exclusion sounds like a stealth killer. If my 15-year-old house burns down and the city requires me to upgrade the wiring or plumbing to 2024 standards, that extra cost isn't covered by my primary dwelling limit.
Precisely. It's a classic example of the kind of nuance you really need to understand. Everything not on that exclusion list is covered, but those listed items represent massive potential liabilities you have to plan for.
Okay, let's pivot to the pricing side of this. Pricing and the risk equation. The annual premium, that indivisible amount we talked about, it's based on a really complex risk calculation. What are the major factors that determine that final price?
Well, the three major interlocking factors are location, the coverage type, so named versus open perils, which represents the risk profile, and crucially, the amount of insurance purchased. And we need to reiterate, this amount is based solely on the estimated replacement cost, the actual cost to rebuild the structure, not the market value, which includes the cost of the land, schools, and neighborhood desirability.
And what can a homeowner do to, proactively lower that price? It seems like insurers would reward measures that reduce their exposure to risk.
They absolutely do. They use premium discounts to incentivize mitigation. The sources point out that prices may be lower if your house is right next to a fire station, which reduces response time. You can get significant discounts for features like fire sprinklers, advanced fire alarms, and security systems. And in high-risk areas, proactive wind mitigation measures like specific roof tying standards or hurricane shutters can drastically reduce your premiums. Insurer-approved locks on doors and windows can also lead to modest reductions. All these things signal a reduced risk.
This brings us to a major financial danger zone that sits right at the center of this risk equation, the danger of underinsurance. We hear about this all the time, but why is it so risky, and what's the punitive mechanism that insurers use when your coverage is insufficient?
Underinsurance just means the amount of coverage you purchased is significantly less than the amount actually required to rebuild your home at current construction costs. Insurers have internal rules often requiring coverage to be at least 80% of the replacement cost. If you, the homeowner, fall short of that required amount and you file a partial claim, you face a coinsurance penalty.
A penalty, so not just a shortfall in coverage, but an active penalty on the claim payout. Can you walk us through a simple hypothetical?
Yeah, let's make this tangible. Say your home requires a $300,000 replacement cost, but you only purchased $200,000 in coverage. You are underinsured. Then you have a fire that causes $60,000 in damage. The insurer calculates the penalty based on a simple ratio, the amount of insurance you did carry divided by the amount you should have carried.
Which in that case is $200,000 divided by $300,000, or about 66.7%.
Correct. The insurer will only pay that percentage of your loss. So they take your $60,000 covered loss and they multiply it by 66.7%. They'll pay out about $40,000 minus your deductible, forcing you to eat the remaining $20,000 as a penalty for being underinsured. And notice, even though your loss was small compared to your policy limit, that penalty still applies.
That is a shocking trap. The sources noted that a 2013 survey found something like 60% of homes were undervalued by an estimated 17%. That means most people listening right now are actively exposed to this coinsurance penalty and probably don't even know it. That's a serious consumer responsibility trap.
It's widespread, and it really highlights why relying on old estimates is so dangerous. Estimates can be too low, not just because of inflation, but because of what we call demand surge after a major catastrophe. If a hurricane hits, suddenly every contractor and every sheet of plywood within 500 miles is in high demand, and rebuilding costs can skyrocket 20% overnight, making your old $300,000 estimate totally obsolete.
So how do insurers try to safeguard the consumer and, themselves against this catastrophic, unexpected inflation?
They offer critical endorsements. These are typically called guaranteed replacement cost, or GRC, or extended replacement cost endorsements. These provide a buffer. GRC promises to pay the full cost to rebuild, even if it exceeds your coverage limit. Extended replacement cost usually provides an extra percentage buffer, say 25% or 50% above the stated limit. It's a vital protection against that unexpected demand surge inflation, and if you live in a catastrophe-prone area, it's arguably mandatory coverage.
The U.S. system, characterized by these complex forms, HO2, HO3, HO5, is confusing, but the good news is most of us don't have to wade through 1,000 pages of individual variations thanks to a historical movement towards standardization. Let's look at where these specific policy forms came from.
Right. The history confirms that the complexity we deal with today is, ironically, the simplification of yesterday. Imagine trying to insure your home back in the 1940s. Before the 1950s, homeowners had to purchase separate policies for every single major peril.
Wait, so separate policies for fire, another for theft, a third for personal property. That sounds like a constant administrative nightmare.
It was a paperwork disaster. It was confusing for the consumer and just really inefficient for the industry. Then, in the 1950s, policies were developed to bundle this coverage into a single package. But those early packages still varied wildly from one company to the next, which made comparing quotes for understanding your coverage nearly impossible.
So standardization became necessary not just for consumers, but for the entire marketplace to function efficiently.
Absolutely. The fragmentation was a huge problem. The solution arrived in 1971 with the formation of the Insurance Services Office, or ISO. Their whole purpose was to provide shared risk information to the industry and, most importantly, to issue simplified, standardized homeowners policy forms that virtually all insurance companies could adopt and resell. This created a level playing field and is the origin of the common HO forms we use today.
So the U.S. system is complex, but standardized, which is better than complex and chaotic. Let's use the 2016 data, the most recent detailed breakdown we have from the NAIC, to understand which policies really dominate the market.
Okay, of the owner-occupied policies, the dominant structure is crystal clear. The HO3 Special. It accounted for a staggering 79.52% of the market.
Wow, so nearly 4 out of 5 homeowners rely on this specific form.
They do. And the HO3, as we established, is an open perils policy. That means the vast majority of Americans believe they have all risks coverage, focusing only on that exclusions list.
Right.
The second most common type is the HO5 Comprehensive at 13.35%. This is the most expensive and most comprehensive version you can buy, also operating on an open perils basis for both the structure and your contents.
So if you add that up, roughly 93% of the market is using an open perils approach. What about the named perils forms?
There's a small fraction. The HO2 Broad policy, which covers only specific named perils, accounted for just 5.15% of the market. The rest includes very limited options like the HO8 Modified.
The HO8 is distinct, and the sources highlight a really critical concept here: actual cash value versus replacement cost.
This is a major difference in the quality of protection you get. Most policies, like the HO3 and HO5, pay the replacement cost, or RC. That's the money needed to replace the item or structure without any deduction for depreciation. The HO8, which is often used for older homes where rebuilding to modern standards just isn't feasible, pays only the actual cash value, or ACV.
And ACV is just replacement cost minus depreciation. Give us a concrete example of why that difference is so huge for a homeowner.
Let's use the roof example again. A new roof costs $20,000. If that roof is 15 years old and has an expected 20-year lifespan, it has depreciated significantly. Under an ACV policy, the insurer might determine the roof is worth only $5,000 today. You only get the $5,000 minus your deductible, and you have to pay the remaining $15,000 out of pocket to replace it. Under an RC policy, you receive the full $20,000. ACV makes the policy much cheaper, but the financial exposure for you is just vastly greater.
We should also touch upon policies for people who don't own the dwelling. I'm thinking renters and condo owners.
Right. Renters use the HO4 contents broad form. Since the landlord's blanket policy covers the building structure, the HO4 focuses solely on covering the contents of the apartment. And critically, it covers personal liability arising from injury to your guests. It's essential, even if you don't own the walls.
And then you have the condo owners.
That's the HO6 unit owners policy. This is designed to bridge the gap between the master policy, which covers the exterior and common areas, and your personal property inside. The HO6 covers the part of the building that you own, usually from the studs in, so interior walls, fixtures, upgrades you've made. The association's bylaws often dictate precisely what minimum coverage you're required to have.
Now let's talk about those modern headwinds. We established that the vast majority of homeowners are relying on this standardized HO3 model. But the sources noted that homeowners insurance has been, well, relatively unprofitable recently. Why is this struggle for profitability hitting the industry so hard?
It's a vicious cycle, and it's driven by two primary forces. First, the increasing frequency and severity of catastrophic losses, hurricanes and wildfires. And second, there's a simultaneous regulatory reluctance. State regulators often refuse to authorize the price increases that insurers feel are necessary to cover their actual risk exposure.
So if they can't raise prices enough, they have to reduce their risk exposure and cut costs. How exactly are companies diverging from that formerly standardized ISO model to do this?
This is the really concerning trend. They are reducing coverage terms, even within policies that are still called an HO3. The sources specifically highlight significant restrictions on certain types of water damage. Water damage from boost pipes, which used to be universally covered, has been either severely restricted or in some cases entirely eliminated in many new policies because it's just become too frequent and costly.
Wait, that's a massive change in standard protection. What else is being narrowed?
We've also seen new, stringent time limits for filing claims, complex replacement cost calculation methods that might lowball the true cost of rebuilding, and reductions in wind damage coverage, especially in high-risk zones like coastal regions. The standardization that defined the industry for 50 years is actively eroding in real time because of this financial pressure. You have to read your policy renewals every single year.
Let's pivot to a scenario where the homeowner just stops paying for insurance altogether, often because they can't afford the rising premiums. The mortgage lender has a crucial backstop here: collateral protection insurance, or CPI.
Right. Mortgage lenders usually require HOI as a non-negotiable condition of the loan. If the homeowner cancels that insurance, the lender can force place CPI. They pay the premium for this highly expensive coverage, and then they charge that premium directly to the homeowner, typically through the escrow account.
That sounds punitive, but I guess necessary for the lender. Who actually benefits from CPI, given that the homeowner is paying a very high premium for coverage they didn't even choose?
Well, CPI is designed primarily to benefit the mortgagee, the lender. It ensures that if the collateral, the home, is destroyed, the loan balance is paid off. It's a single interest policy. While some CPI does cover damage that impacts resale value, which can indirectly help the homeowner, the main benefit to you, the borrower, is preventing immediate mortgage default. Without it, you'd be in serious breach of your contract, and the lender could legally call in the entire loan, demanding immediate repayment. CPI is a very expensive, heavy-handed way to prevent that total catastrophe.
Let's look at the practical side, the mechanics of a claim, and then transition into the huge economic forces shaping the industry, namely these weather disasters. So Section 4 starts with the claims process. I've filed a claim. What are my obligations as the insured?
As the homeowner, you have homework after a disaster. You're expected to take steps immediately to mitigate the loss, which just means prevent further damage. If a roof is damaged, you have to temporarily tarp it even before an adjuster arrives. You also have to notify the insurer within a reasonable period. After that, a claims adjuster investigates, and you may be required to provide everything from inventory lists to police reports to support your claim.
And what's the hidden cost of actually using the insurance you pay for every month?
Filing a claim carries a cost beyond your deductible. It may result in a non-renewal notice from your insurer, meaning they won't offer you coverage the following year. Or it could mean an increase in your rates. If you have multiple claims in a short period, cancellation is a very distinct possibility, regardless of how minor the losses were.
This is where the insurance industry's internal communication is fascinating. Insurers don't just judge you on your claims, they share data across the entire industry. Tell us about the centralized databases they use.
Insurers share claim data in these massive industry repositories. The big ones are CLUE, that's the Claim Loss Underwriting Exchange, and APLOS. This is a comprehensive, consolidated history of risk. Our sources indicate that CLUE receives claim data from an astonishing 98% of U.S. insurers.
98%. That's nearly total market surveillance. So a claim I filed today in Texas could raise a red flag when I move to Oregon and apply for a new policy 5 years from now.
Precisely. It creates a complete history of the property and the owner. And crucially, if you even just inquire about a loss but don't end up filing a claim, that initial inquiry is often recorded too. And that can influence your future insurability and pricing across the entire market. That's why you have to be very careful before even calling your agent.
Okay, let's analyze where the premium money actually goes by looking at the causes of loss. We have some 2005 data breaking down the costs for every $100 of premium collected. What is the single largest cause of loss?
It's clear that atmospheric risks are the primary threat. Wind and hail took the largest share of the premium dollar, accounting for $30 out of every $100.
Wow, that's nearly a third. It's interesting that wind and hail are double the cost of fire, which often feels like the most dramatic risk.
It is. Fire and lightning came in second at $16. Then, Water damage and freezing accounted for $11. Theft was surprisingly low, just $2. The remaining dollar amounts cover things like liability, medical payments, and of course, the general insurer operating expenses.
That cost of wind and hail leads us directly to the massive financial strain that increasing weather severity is putting on the entire insurance model. You identified this earlier as the primary reason for all those reduced coverage terms.
This is where the long-term viability of the current system is really being tested, not just in the U.S., but globally.
Yeah.
NOAA data confirms that damages from weather-related disasters in the U.S. amounted to approximately $92.9 billion in 2023 alone. That figure is just staggering.
That's just 1 year of disasters, and the consumer impact is immediate and brutal.
It is. Insurance costs rose nationally by 13% between 2020 and 2023, driven directly by these frequent severe events. And this pressure isn't just driven by localized claims, it's driven by the costs of the insurers protecting themselves.
All right, that's the reinsurance factor. Can you explain how reinsurance increases consumer premiums?
Reinsurance is basically insurance that insurance companies buy to protect themselves from catastrophic losses that would otherwise bankrupt them. Think of it as stop-loss insurance for the industry. Because global weather risk is soaring, the expenses for reinsurance have become a key contributor to rising costs for every homeowner. Our sources show those reinsurance costs have doubled between 2017 and 2023. That huge rise is immediately passed down to you, the consumer, via increased premiums.
What's fascinating here is the sheer financial strain on the insurers themselves. Are they even making money on the policies they sell?
The answer is a resounding no. The sources show a really stark reality. For the 5th consecutive year, insurers have paid out more in claims and expenses than they collected in premiums. And in 2023, the industry dispersed an astonishing $1.11 in claims and expenses for every single dollar received in premiums.
Wait, they're paying out $1.11 for every dollar they take in. That means the industry is fundamentally operating at an underwriting loss. That is not sustainable on premiums alone.
It's entirely subsidized by investment income or by drawing down capital reserves. It confirms that the risk model, as it's currently priced and regulated, is broken. And projections look grim, too. Swiss Re expects global insured losses from natural disasters to hit $107 billion in 2025. This rising global risk pressure ensures that policy premiums and restrictions will just continue to increase.
Okay, let's connect this crisis to the bigger picture and look beyond the U.S. The U.S. system is characterized by these standardized, complex HO forms that combine property and liability. But other countries, like in Europe or Australia, often use a more streamlined approach known as building and contents coverage.
That's right. This model is often considered more straightforward because it neatly divides the property risk into 2 distinct categories. However, we have to stress that, relative to a comprehensive U.S. HO3 policy, the standard building and contents model offers a more basic level of coverage in its baseline form. You often have to build up the protection with add-ons.
Let's look at the 2 main components of this model. First, building coverage. What's that cover?
Building coverage is the equivalent of U.S. coverage, A, the dwelling, and B, detached structures. So it covers the primary structure and garages or sheds. It also typically covers fixtures and fittings that are permanently attached to the building, things like fitted kitchens and bathrooms.
Is the coverage for the property outline completely universal in this model, though?
No, and this is a critical difference from the U.S. standard. Different insurers may specifically not cover exterior elements like boundary walls, fences, gates, paths, drives, or even swimming pools under the standard building policy. You really have to check the specific policy language for these perimeter structures. Got it. Second, contents coverage. This covers personal effects, furniture, electronics, clothing. But there's a key financial limitation here regarding high-value items, correct?
Yes. While it covers those personal items, standard contents policies place severe limits on the amount of money paid out for each category of item. These are known as limits on valuables. For instance, they might cap a jewelry or fine art payout at, say, $2,000, regardless of the value of the individual items. If you own expensive jewelry or collectibles, you absolutely must schedule those items separately if you need higher coverage.
And liability coverage, where does that fit in the building and contents model?
It's typically bundled in. The source material distinguishes liability based on what caused the issue. Building liability covers on-site injuries or damage, like someone tripping on your porch, while contents liability covers off-site occurrences. For example, if a member of your family accidentally causes property damage while traveling abroad, which is a surprisingly broad inclusion. And as with U.S. policies, these international models have common exclusions people need to be aware of. What are the universal non-starters we see across these global models?
Many of them mirror the U.S. system because they're fundamentally about moral hazard and maintenance. So general wear and tear is always excluded. Issues from faulty workmanship or contractor error are typically out. Mechanical or electrical breakdown of appliances is also usually excluded. And crucially, many policies impose severely restricted cover when the home is empty for extended periods, often 30 to 60 days, or if the property is let to tenants, as both of those scenarios increase the risk profile.
Okay, let's do a quick country spotlight, starting with the UK, which operates on this building and contents model. What requirement do lenders impose there?
It's similar to the U.S. Lenders require insurance, but specifically for the rebuild value. This is the estimated cost of clearing the site and rebuilding the property from scratch. It is often lower than the market value of the property, which is an important distinction for homeowners who are used to the U.S. focus on market prices.
And are UK insurers feeling the same financial pressures from weather?
They are, yeah. UK premiums are rising due to increased fraud and the increasingly unpredictable weather patterns, particularly severe localized flooding. This has led to a significant consumer shift toward price comparison sites, which drives a highly price-sensitive market.
And what about the concept of non-standard risks in the UK?
The UK has a distinct category for this, and it's estimated to include about 8 million households. These are risks that require a specialist insurer and can't be quoted on standard comparison sites. This includes situations where the policyholder has criminal convictions or where the property has suffered previous serious structural issues like subsidence or has been underpinned.
Okay, across the ocean to Canada, how does their system compare?
Canadian insurance is divided into the three common categories: homeowners, tenant, and condo insurance. They commonly use all-risk policies, which, like the U.S. HO3, are comprehensive and cover all losses not specifically excluded.
And have they been shielded from the catastrophic weather issues affecting the U.S.?
Unfortunately, no. Premiums in Canada have increased significantly due to destructive natural disasters. Since 2013, severe floods and wildfires have caused tens of billions of dollars in insured damage, and that directly necessitates those major price hikes across the entire country, regardless of the specific region. The climate stress on the insurance model is truly a global phenomenon.
We've covered a massive amount of ground today. We've moved from the philosophical core of indemnity to the complex mechanics of named versus open perils. We've dissected the history of U.S. standardization and finally analyzed the global pressures of climate change and profitability.
The goal was to provide that quick, thorough understanding and to, demystify this critical contract. I want to leave you with 3 key takeaways from the source material that you should immediately apply to understanding your own policy.
Okay, lay those crucial takeaways on us.
First, reinforce the crucial definition of insurance as a contract of indemnity. It is designed to restore you to your prior state, not to reward or profit you. This really resets your expectation during a claim. Second, you must actively identify and understand the policy type you hold. Is it named perils, like an HO2, where the coverage list is everything you can claim? Or is it open perils, like an HO3 or HO5, where the exclusion list is the only thing that matters? Knowing this determines the viability of any unusual claim.
And the third, most critical financial point, the one that could save listeners from a huge financial shock.
It is the pervasive and often hidden financial threat of underinsurance and the potential for that coinsurance penalty. Because of inflation, demand surge after catastrophes, and rising rebuilding costs, the potential for that penalty to negate a significant portion of your claim is high. You have to regularly review your policy limits against the true current replacement cost of your home and seriously consider those guaranteed or extended replacement cost endorsements, particularly if you live in a high-risk region.
That is actionable knowledge that can save you thousands and prevent a catastrophic financial failure. We started with the question of why this contract is so confusing, and hopefully we've made the policy structure far less opaque. But this deep dive leaves us with one final provocative thought for you to consider as you review your renewal documents this year.
It raises an important question. We noted that the insurance industry is already in the red, paying out $1.11 in claims and expenses for every dollar they take in from premiums. If climate change continues to increase the frequency and severity of losses, and if regulatory reluctance prevents insurers from adequately raising prices, what is the ultimate long-term fate of the single, comprehensive, multiple-line HO3 insurance policy as we know it today?
Will coverage become drastically narrower, perhaps eliminating entire categories of loss like water damage? Will it become so expensive that only the wealthiest can afford comprehensive protection? Or will the structure fundamentally shift, perhaps requiring separate, mandated government policies for weather risk and leaving private insurers to cover only fire and liability? Something has to give when the math doesn't add up year after year. Thank you for joining us for this deep dive into the cost of protection. We'll see you next time.